Peter Lynch, a name synonymous with investment success, needs little introduction. As the legendary manager of Fidelity's Magellan Fund from 1977 to 1990, Lynch achieved the unthinkable. He grew the fund from a modest $18 million to a staggering $14 billion, boasting an average annual return of over 29%. This phenomenal track record cemented his place in the pantheon of Wall Street legends. But what truly sets Lynch apart is his belief that anyone, even the everyday investor, can achieve similar success. This belief forms the crux of his investment philosophy, meticulously outlined in his seminal work, One Up on Wall Street. One Up on Wall Street is more than just an investment guide. It's a clarion call to individual investors. Lynch dismantles the myth of Wall Street's exclusivity, arguing that ordinary people have a distinct advantage in the market. After all, who knows a company's products better than its loyal customers? Who understands the pulse of a local business more than the community it serves? Lynch empowers readers to leverage their everyday experiences, transforming them from passive consumers to savvy investors. The book emphasizes that investment success isn't about esoteric financial models or insider information. It's about observation, common sense, and a willingness to do your homework. Lynch encourages readers to invest in what they understand, advocating for a buy-what-you-know approach. This simple yet profound principle demystifies investing, making it accessible to everyone. One Up on Wall Street offers a structured roadmap for aspiring investors. Each chapter delves into a specific aspect of Lynch's investment philosophy, providing practical advice and actionable insights. Chapter 1: Investing as a Profession. Lynch sets the stage, highlighting the advantages individual investors have over Wall Street professionals. He emphasizes the importance of long-term thinking and staying invested, even during market fluctuations. Chapter 3: Is this gambling or what? Lynch draws a clear distinction between investing and speculating. He advocates for a disciplined approach, urging investors to focus on a company's fundamentals rather than market noise. Chapter 6: Stalwarts. Lynch introduces his categorization of stocks, explaining the characteristics of stalwarts, large, established companies that offer stability and steady growth. Chapter 7: Cyclical. This chapter explores cyclicals, companies whose fortunes are closely tied to economic cycles. Lynch emphasizes the importance of timing when investing in such companies. Chapter 8: Fast Growers. Lynch discusses the exciting world of fast growers, smaller, rapidly expanding companies that have the potential to generate outsized returns. Chapter 10: The Perfect Stock. What is it? This pivotal chapter outlines the key characteristics Lynch looks for in a company, including strong earnings growth, low debt, and a competitive advantage. These chapter highlights provide a glimpse into the wealth of knowledge contained within the book's pages. Each section builds upon the last, creating a comprehensive guide to Lynch's investment methodology. At the heart of One Up on Wall Street lies a set of investment principles that have stood the test of time. These principles, distilled from Lynch's years of experience, provide a framework for identifying winning investments. Invest in what you know. This cornerstone principle encourages investors to leverage their existing knowledge and experience. If you understand a company's products and business model, you're better equipped to assess its potential. Look for companies with a strong track record. Lynch emphasizes the importance of investing in companies with a history of consistent earnings growth and sound financial management. Focus on the long term. Lynch advocates for a long-term investment horizon, encouraging investors to ride out market volatility and allow their investments to compound over time. Don't be afraid to buy when others are selling. Lynch believes that market downturns present excellent buying opportunities. When fear grips the market, it's often the best time to scoop up undervalued stocks. Do your homework. Lynch stresses the importance of thorough research. Understanding a company's financials, competitive landscape, and future prospects is crucial before making any investment decision. These timeless principles, presented in Lynch's signature clear and concise style, provide investors with a solid foundation for navigating the complexities of the market. Case studies in success from donuts to department stores. One Up on Wall Street is replete with real-world examples that bring Lynch's investment principles to life. One such example is Dunkin' Donuts. Lynch, an avid coffee drinker, noticed the long lines and loyal customer base at Dunkin' Donuts outlets. This simple observation, coupled with his research into the company's financials, led him to invest in the company, which went on to deliver impressive returns. Another example is La Quinta Motor Inns. Lynch, a frequent traveler, recognized the growing demand for affordable, high-quality lodging options. He saw La Quinta's clean and efficient motels as a compelling investment opportunity, which proved to be a shrewd decision. These anecdotes illustrate the power of Lynch's buy-what-you-know approach. By investing in companies whose products and services he understood firsthand, Lynch was able to identify winning investments that traditional Wall Street analysis might have overlooked. Despite being written in the late 1980s, One Up on Wall Street remains strikingly relevant in today's rapidly evolving market. While the technological landscape and investment tools have changed dramatically, the fundamental principles of investing remain the same. Lynch's emphasis on understanding a company's business, analyzing its financials, and taking a long-term perspective holds true, regardless of whether you're evaluating a brick-and-mortar retailer or a cutting-edge tech startup. His focus on identifying companies with a durable competitive advantage, strong management teams, and consistent earnings growth transcends industries and market cycles. In today's world of high-frequency trading and complex financial instruments, Lynch's common-sense approach to investing serves as a refreshing antidote. His book reminds us that investment success isn't about chasing the latest trends or timing the market. It's about identifying fundamentally sound companies and holding on to them for the long haul. While Lynch acknowledges the importance of financial metrics, he emphasizes that numbers only tell part of the story. He advocates for a holistic approach to research, encouraging investors to look beyond the balance sheet and consider qualitative factors such as company culture, management quality, and the competitive landscape. A strong company culture, characterized by innovation, customer focus, and employee empowerment, can be a key driver of long-term success. Lynch believes that a company's leadership team plays a pivotal role in its success. He looks for managers who are honest, competent, and aligned with shareholder interests. Understanding a company's competitive environment is crucial. Lynch encourages investors to assess the strength of a company's moat, its sustainable competitive advantages that protect its profits from competitors. By considering these qualitative factors, investors can gain a more nuanced understanding of a company's prospects and make more informed investment decisions. One Up on Wall Street champions the individual investor, highlighting the unique strengths they bring to the table. Unlike institutional investors who face pressure to generate short-term returns, individual investors have the luxury of patience. They can afford to take a long-term view and ride out market fluctuations. Moreover, individual investors have the freedom to invest in companies of any size, from small-cap growth stocks to large-cap blue chips. They aren't constrained by the investment mandates or bureaucratic hurdles that often plague institutional investors. This agility allows individual investors to capitalize on opportunities that larger players might miss. Finally, individual investors have the advantage of conviction. They can invest in companies they truly believe in, based on their own research and analysis. This sense of ownership and alignment can lead to greater patience and discipline, ultimately enhancing long-term returns.
I don't ever slow up, no I don't take shit. I got no love for the fakeness. If you wanna play tough and wanna hate this, I'll always show up. I don't ever slow up, no I don't take shit. I got no love for the fakeness. If you wanna play tough and wanna hate this, I'll always show up and make a statement. I don't ever slow up, no I don't take shit. I got no love for the fakeness. If you wanna play tough and wanna hate this, I'll always show up and make a statement. Everything I do so instinctive and so passionate. Every word I move so descriptive like an adjective. I got a vendetta against people who patented being negative when you should be getting after it. I got facts over tracks, this and that. Spitting slow, spitting fast. I could roast, I could gas. Think I'm okay at last, but I
think financial freedom.